Hello everybody, welcome back to class, and we're going to be talking about long-term liabilities, and we're primarily going to be focusing on bonds, so we'll just touch on notes just a bit. To start off with, let's talk about what a bond is. A bond is almost like a long-term loan for any sort of corporation. Think about the ways that a corporation has to raise money. They can either make money of their own, of course, and that's one way that they have money within their business. But another two ways that a company has money or corporation has money is to issue stock, which is issuing capital, which we talked about in the last section, which basically people are buying stock and they're giving us money and we're giving them a share of our business. The other option here is a bond. Now with the stock, you don't have to pay back any sort of money or anything. The only thing you have to pay to shareholders might be dividends in the future, and that's not even mandatory, unless we're talking about a preferred stock situation where we've told them we are going to pay them back some sort of dividends. A bond, on the other hand, is something that does have to be repaid. All right, so if we had a corporation and we needed some money and we decided to raise that money through a bond issue, what we would do is we'd put the bond issue out there into the world and people would basically give us money for a specified period of time and at a certain interest rate that's also going to be specified. So here's what's going to happen. So people might give us $1,000 and we would give them this bond. And it might be a 10-year bond, it could be a 20-year bond, usually it's for a longer period of time. And during that period of the bond, we will get, as the corporation, we're guaranteeing them, we're paying them some sort of interest. We might pay that interest annually, semi-annually, quarterly. It depends on what you have agreed to in your bond agreement. Okay, so what happens here is that we pay them interest throughout the 10 years or so that the bond is stated for, and at the end of the time, what we would do is we would pay them back their $1,000. So it's pretty much a long-term loan, if you want to think of it that way, that we're getting money lent to us by, your average investor. Okay. Now, one of the benefits of issuing stock, like I said, is if you issue just common stock as a means of raising money, you don't have to pay anybody back anything. You just might decide at some point you're going to pay some dividends to those common shareholders, but that is your choice. If you issued preferred stock, you will most likely have to pay dividends out to your shareholders. Okay, so there's some considerations here. There's many different ways to raise money, and you've kind of got to make that decision based on what's the right path for your company. Now, when you're making this decision as to whether or not to issue bonds or preferred stock or common stock, what you'd have to do is you'd have to almost run the numbers. You'd have to see what it does to your company to issue bonds or to issue common stock or to issue preferred stock. You can't just say, well, I think we're going to issue common stock this time and next time we'll issue some bonds. Instead, it makes more sense for you to run the numbers and see what issuing bonds does to your net income in your company, or issuing preferred stock. What does that do to the numbers in your business? All right, so we're going to be looking at this Huckabee Corporation, and in a few minutes I'm going to figure out how to split screen this so I can keep this information up here and go through the actual calculations with you on screen. But before that, I want to talk about one other concept, which is earnings per share. There are a number of financial analysis ratios that companies use, that are used to evaluate the company's performance. The most common ratio used is something called earnings per share. Earnings per share is the only ratio that is actually required to be on financial statements. All right, for the rest of them, people can run those ratios. Anybody analyzing a company can run the financial ratios, but earnings per share is actually required to be on those financial statements, and that is the only one that has that criteria. Okay, so what earnings per share means is you're basically looking at, if you see the calculation is net income minus any preferred dividends over the number of common shares outstanding. So what this is saying, let's pretend we didn't have any preferred dividends and we just have net income. Let's say a business has $1 million in net income, has no preferred dividends, and the number of common shareholders outstanding is, we'll say, 100,000 shareholders. Okay, that means there's 100,000 shares of common stock out there in the world. You'd have $1 million over $100,000, so that would mean your earnings per share number would be $10 a share. Now, that's a really high number, but we're just to use it for illustration purposes. The idea here, what that $10 per share means, is that for every single person who owns a share of stock, the company basically earns $10 for that person. That's the idea behind earnings per share. So the higher the number is, the better it looks for the company. Okay, so earnings per share is an important number to keep high because what people do is they look at the financial statements and they say, oh wow, their earnings per share number keeps going up. Basically, that indicates growth to the average person. All right, it means the net income is going up. They don't really think about the number of common shares outstanding. But the point is earnings per share number is a dollar value, and it's usually like $2.50 or $4.20 or something along those lines. And as long as the number stays high, usually people are like, hey, their earnings per share looks good, I'm going to invest with them. So that's an important number to factor into any calculations as well. So when we run these scenarios, deciding whether or not we're going to issue bond, preferred stock, or more common stock, we're going to have to look at what the scenarios do to my earnings per share number as well as everything else. Okay, so here's the information we're going to be looking at. We're looking at this Huckabee Corporation. They have earnings before interest and taxes. Okay, so what this is almost the income statement has been done above this line. All right, you've had all of your revenues minus all of your expenses, you have operating income and so on. And where you're at is at the very bottom of the income statement, and you're basically at the earnings or net income, kind of. But earnings before any interest, and by this we mean bond interest or taxes. Okay, before those have been deducted as expenses from your income statement. All right, so it's the money you've made before you pay out any bond interest and before you pay taxes. And that's going to be the number we start with in these calculations, is $800,000. We're assuming a 40% tax rate, and we're assuming that bonds or stocks are issued at their par or face value. All right, we'll get into bonds being issued at something other than their face value in a little bit. Okay. Okay, so here we go. Here's the setup. So, no matter what the situation is that we're looking at here, we're trying to raise $4 million. And the question is, in Plan 1, we're raising $4 million worth of common stock. And that's how we're going to raise the $4 million. In Plan 2, we're going to issue a combination of common stock and preferred stock. And in Plan number 3, we're going to go with common stock, preferred stock, and some bonds. Okay, so now no matter what the situation is, we're starting off with $800,000 in earnings before interest and taxes. Okay, that's a given. Let me format all this the right way. Commas, no zeros. Okay, so we've got $800,000. No matter which plan we go with, we're starting off in the same place. All right, $800,000. So let's focus on Plan 1. In Plan 1, we're only issuing common stock. So in this case, we're not going to have any bond interest. Okay, so that's going to be a 0. We've got 800,000 minus 0. Oops, didn't like that. All right, so we still have $800,000. Now taxes, we were told we're at a 40% tax rate, right? So 40% of $800,000 is $320,000. So we're going to subtract $320,000. Net income is going to be $480,000 then. Okay, that's where, so we have that number. So when we get down to our earnings per share calculation, we're going to be starting off with our net income being $480,000, but I'll get there in a second. Let's talk about preferred dividends for a minute. Well, actually, no, let's not talk about it for a minute. We'll talk about it when we're actually issuing any preferred dividends. In this first scenario, Plan 1, we're not issuing any preferred dividends. We're not issuing any preferred stocks, so we don't have any preferred dividends to pay out. So again, we're at a 0 here. So when we come down to our earnings per share number, it's going to be $480,000 in net income minus 0, so really nothing, right? Divided by the number of common shareholders outstanding. Well, if we're issuing $4 million in stock and each stock is worth $10, then we're looking at 400,000 shareholders. Okay? I mean, this makes sense. 400,000 common shareholders times $10 a piece gives you $4 million in stock. So our number of common shareholders is 400,000. Our earnings per share number is $1.20. Okay, that's the first scenario. Let's look at the second one. In the second scenario, we are still, let me copy my formulas so I don't have to do them again. Okay, but we will get rid of the numbers. All right, our first scenario, we start off with $800,000. Again, we don't have any bond interest to pay out because we're not issuing any bonds. So we still have $800,000. We're going to pay $320,000 in taxes at a 40% tax rate. Nothing there has changed. What is going to change is our preferred dividends. Okay, our preferred dividends are going to be calculated by the same way we just calculated out the number of common shares of stock. We've got $2 million in preferred dividends. In preferred stock, and they're being issued at $50 a piece. So if you take $2 million, make sure I have enough zeros, divided by $50 per share of stock, that is 40,000 shareholders. All right, 40,000 people are holding a share of preferred stock. Now, for those 40,000 people that are holding a preferred share of stock, what they're expecting is they're expecting a dividend because it is preferred stock. So you've got a $50 par value, and when they give you that number of 9% here, they're basically saying every person holding a $50 par value share of stock wants to get their dividend of $50 at 9%, which is $4.50. So all 40,000 of these preferred shareholders are expecting to get $4.50. Oops, it's rounding it. So what that equates to in dividends is 40,000 at $4.50 apiece. They expect to get $180,000 in dividends paid out.